And now our top line story. It's a story that has the technology industry buzzing this morning. Sam Altman, the artificial intelligence pioneer who founded OpenAI, was fired by that company on Friday amid reports of deep divisions on that company's board of directors. Over the weekend, there were reports that Altman might be hired back at OpenAI. But then, early this morning, the chief executive officer of Microsoft posted this on X. Satya Nadella announced that Altman and another former OpenAI executive had been hired at Microsoft to lead that company's artificial intelligence efforts. And investors are impressed. Shares of Microsoft, which are already in record high territory, have gained in pre-market trading. They're up about 2%. To talk about it further, we're joined by Divya Balji. She's managing editor for Breaking News Americas at Bloomberg News, and she joins us now. Divya, thank you so much for making some time early this morning for us. This is quite a story, quite a head spinner through the course of the weekend. Take us through the weekend's developments.
Yeah, I think this started at around, 3 o'clock in the afternoon on Friday, where we got these tweets coming in saying that Sam Altman was out of OpenAI. There were also a few other departures, including the president of OpenAI as well. Now, the reason behind this, or what the board was sort of hinting at, was perhaps that Altman hasn't been very honest to the board about everything that was being done with AI. The board was very concerned about how, safety concerns around artificial intelligence, and they didn't feel like he was actually addressing those concerns. Now, in that time frame, it was very clear that Microsoft had no idea this was happening. Microsoft has invested about $13 billion in OpenAI. They were trying to figure things out. There was also other investors who were saying they wanted Altman back. Altman has been the face of AI since the start of all of this, in particular with OpenAI, but just going out there to conferences, going to Beijing talking about it, going to Washington talking about it, going to all these major corporations to talk about it as well. And this type of an ouster was just such a shocker for the entire industry to see happen. Now we have, over the weekend again, we have Microsoft coming in saying they're going to take Altman into their own company, work on their own AI initiatives. I think what we're waiting for here now is, Microsoft is kind of at the center of this. It has a massive stake in OpenAI. It has brought Altman into its own company to look at its own AI unit. Where does it stand when it comes to OpenAI? Would it look at selling a stake at this point? Then you have to consider the entire valuation of OpenAI as well, which at one point was sitting at $86 billion. But with all of this going on, does it mean that with Altman out, the valuation could drop? There was supposed to be a tender offer as well. Where does that all go? There's still a lot of flux at this company, OpenAI, but also at Microsoft to see what happens next.
Satya Nadella seems to have been a big player in all of this drama. At one point over the course of the weekend, there were reports that he was among the people pushing the board of OpenAI to take Sam Altman back, correct?
That's exactly right. I mean, the fact that the board wasn't willing to do it also shows this huge divergence between what the board at OpenAI wants and what Microsoft wants, really. And if he couldn't get his way, then he decided, okay, we'll bring Sam Altman back into our company in a different way. We'll wrap him up into Microsoft itself and work on our own AI unit. But he is a huge name in the industry, Satya Nadella is, and the fact that he's seeing this in a very different light from OpenAI tells you where he stands when it comes to OpenAI security, all of those concerns as well.
Divya Balji, thank you so much, as always. Divya is the managing editor for Breaking News Americas at Bloomberg News, and she joined us from the Bloomberg News Bureau in Toronto.
Well, let's bring in Tom Rand now. He's managing partner at Arcturn Ventures. Tom, you're focused on the climate strategy, investment in that space. I'm interested to know what you think of what we're seeing from this fiscal update. It seems like there's some more details when it comes to rolling out the programs that have been long awaited in terms of the carbon capture, utilization, and storage being one of them.
Yeah, there's been a lot of discussion over a number of years around the investment tax credit and how the federal government is going to support these kinds of projects across a number of sectors: carbon capture, clean energy, hydrogen. And until now, it's been fairly ad hoc on the ground. And so I think what the community is looking for is clarity. So to have legislative clarity, some numbers, timelines around that capital and how it flows. And it's also important to get clarity on that because Canada is already at a slightly disadvantage because we have a number of different kinds of policies, carbon pricing, incentives, and you have to kind of mix them together to get a net effect on a particular project. And it's a non-trivial kind of math problem to solve. But when you're going up to raise capital, you need clarity to get the private capital to commit first. And the Americans have the advantage of an enormous amount of clarity that came out of the IRA. And so Canada's beginning to define some clarity around the numbers, as well as putting dollars to work, which is good to see at last.
What has the investment environment then been like out there if you were sort of hanging and waiting for these details?
Well, I'll give you an example that hits home. Woodland Biofuels is a company we've invested in. They build facilities $500 to $700 million a piece that make carbon negative molecules, hydrogen, renewable natural gas. We had a site in Sarnia. We were moving ahead to build that plant in Sarnia. We had offtake agreements. We had EDC supporting us, but we couldn't get clarity around the overall financial picture and incentives for the facility. So as soon as the IRA was announced, we put everything on hold, and we're now got 5 or 6 sites in the US that we're building, and we will probably come back to Canada and build subsequent to this. If this clarity had been in place 18 months ago, we probably wouldn't have made the effort to move to the United States. But we had no choice. It was so compelling to go down there. Not just the actual dollar amounts, but the fact that you can say to the private backers, the equity investors, here's where the other pieces of the capital stack are going to come from.
Yeah.
We have to jump through hoops to get them, but we know what it looks like and we know our probability of getting them. Whereas in Canada, it seems to be more like if you know a minister and you're a big company, you can have a closed door meeting and build a battery plant and get billions and billions of dollars. That's okay, but it's very ad hoc, and it doesn't help those companies that don't have massive balance sheets and need to go to market to get the equity to build the facility. So Woodland will come back to Canada, but we were attracted by the IRA, for sure.
Is there anything that you'd want to see more clarity on from what you've seen so far out of the fiscal update? Is there anything else that you're still waiting for, Tom?
Well, it's all about timing. I mean, these are still statements. Mm-hmm. We need to see the legislation, and we need to see the details of the legislation. I mean, Canada has in the past had really good ideas around a piece of policy that a minister has championed. When it gets executed, in the execution, it becomes either watered down or it doesn't hit the target it was intending to hit or so on. So the execution of a policy is as important as the idea itself, so we're looking for that.
Okay, Tom, thank you so much for joining us. Really appreciate that. Was Tom Rand, managing partner at Arcturn Ventures.
Welcome back to Bloomberg Markets. So far in November, we've seen some pretty impressive stock market performance. We mentioned earlier the TSX on track right now for its second best month of the year, the gain approaching 7% at this point. In the U.S., the S&P's gain could be one for the record books. Certainly, it's already one of the best months we've seen going back to the summer of 2022. And one of the other considerations, not just more dovish views in the market. I mean, it goes hand in hand with what's been happening in the bond market. Not that long ago, everybody was getting very worried about high Treasury yields. In the case of the 10-year yield, for example, though, we have started to see an easing of that yield, and that is subsequently one of the factors that has helped the stock market. So let's talk to 2 experts on the economy and fixed income to get some more perspective on all of that. Back with us now, Earl Davis, head of fixed income and money markets at BMO Global Asset Management, and Francis Donald, global chief economist and strategist at Main Life Investment Management. Nice to have you back with us. Earl, were you surprised to see this reversal of sorts in the yields for treasuries recently?
No, we weren't. And the reason why we weren't is we've done studies that shown 2023 has been the most volatile year in fixed income in the 2000s. Means significant sell-offs, significant rallies. This goes hand in hand with that. We believe that the catalyst was, the Fed alluding to them being on pause at the last FOMC meeting, and we saw bonds rally, we saw equities rally, and that makes sense. But it's our contention we're now at the lower end of the range for bond yields. It might rally another 15 basis points, but it's already rallied 60. We feel we'll be in this range for the upcoming year,
And just to follow quickly, is that, you talked about whether or not, let's say, the Fed has to hike again. Is that one of the considerations for that volatility?
Without a doubt. There's 2 considerations for the volatility. One is, they're not out of the inflation woods yet, and how resilient the economy is. There's a lot of excess demand, and that's inflationary, so they may have to counteract that. They want to pause. But more importantly, it's fiscal stability. As much as we talk about deficits in Canada, the U.S. deficit is 3 times higher than the Canadian deficit. That's part of the reason of the outperformance of the stock market, of the economy, how employment's doing well. And to offset that takes higher rates as well, too.
Yeah. And talks can get pretty heated on that subject in Washington from time to time. We've noticed, market investors have noticed. Francis, for those who are trying to just figure out fixed income, how it fits into the portfolio, they hear all these headlines. How do you think about what's happening in the bond market right now?
Well, here's where I talk to our portfolio managers about what's going on now. And it's so important to understand your investment timeline, your investment horizon, because right now we're in what we call a tactical Goldilocks or an air pocket, or you can choose another metaphor, for a period in time in which everything seems like it's going our way. We've got inflation that's been coming down. In the US, we've gone from over 9% to 3 and change. Canadian inflation doing better. So the inflation boogeyman is kind of receding. We have growth that has held in there, especially in the United States. It's not collapsing, it's just slowing. Looks very soft landing. And as Earl mentioned, we've had central bankers who said, maybe we can pause, maybe one more. This is the most ideal setting that we can get for stocks and bonds, and it's given us that nice negative correlation back again for those two asset classes. I have similar concerns to Earl, however, which is that when everything seems to be going your way and it becomes a very consensus trade, there are a lot of things that can be disruptive to that. Markets don't move linearly, and neither do economic data. So I am a believer in disinflation, but we could have a few months that surprise to the upside as we move forward. We could have central bankers who say, don't get in front of us and start pricing in cuts. It's too early. The ECB has done that. We could have geopolitical risks, and we have a big election coming up in the United States this coming year. So there are things that I think will burst this bubble. For now, things look good, but beware a little bit more in Q1. I think it'll be more disruptive.
You know, Earl, the markets have so much that there is a macro and a micro. We talk about that all the time in the stock market. You highlight the index, but then you've got this company-specific story. And you've talked to us about different kinds of corporate issuers, corporate debt in the past. I mean, when you think about the kinds of areas you can be investing in right now, how do you think about corporate bonds versus, let's say, government bonds?
Yeah, and you know what? Our story hasn't changed over the past 2 years in the type of corporate bonds we like, because it's about what we say. If you're giving a company money, buying the bond, you want to get that money back, return of capital. You'll get that back from the companies that are able to pass through the cost of inflation, pass through the cost of higher wages, which is typically, as we said it, your Dollarabas, your Sobeys, your Empires. Another kind of outside the box, but traditional investment, we also like the bank stocks. Riskier, yes, because their overall model, less growth, but they're so diversified. And if the U.S. is going to be resilient, they will benefit from that. People are worried about the housing market here, but I think it's a gradual adjustment. There's always going to be a buyer for a house with our immigration policy as we have it now. There'll be volatility, but we think the banking returns and spreads look great as well, too, on their bonds.
Francis, we haven't really even gotten into the actual dynamics of the housing market outside of the mortgage side of it. What do you think the outlook for the housing market looks like?
The Canadian housing market.
The Canadian housing market.
Well, here's a really peculiar. So, Earl, you mentioned earlier that even if things get harder for Canadians, they're probably going to pay their mortgage, just not pay other things. And that's a real cultural dynamic in Canada that even though I'm very concerned about the Canadian economy, I don't have this awfully bearish view on housing. One of the reasons why is because Canadians will, eat beans and rice before they don't pay their mortgage. But secondly, we have a massive supply issue. We all know this. By some measures, we are millions short. And I think this also speaks to some of the limitations in central banking here. We were told higher interest rates will bring down inflation. Higher interest rates have moved up mortgage interest rate, but have not, mortgage interest costs, but have not solved affordability in Canada. Maybe we need to start saying this is not only a Bank of Canada issue, it can't be solved by the Bank of Canada, and what other pain are we inflicting? For now, what I see is much slower growth, slower housing activity, but no particular collapse. It is not the Canadian way. Famous last words, probably.
A Canadian raincoat brand, Newfoundland, is being showcased in British Vogue. Our guest, the woman behind the brand, says the raincoat is inspired by the fishing industry in Newfoundland and Labrador. Of course, they have to deal with cold and wind and rain and snow that come from all directions. We're joined by Maria Halfyard. She is the founder of Marini. Thanks very much for coming on the show.
Thanks for having me, Andrew.
We have some shots of these coats. How did British Vogue get to hear about them?
They just emailed me. I think they did some research on up-and-coming designers and brands around the world. So they looked me up on social media or found me. and then learned a bit about my story. And then I was shortlisted and had the opportunity to be in the next 3 editions, actually.
Good stuff. Now, give us your stuff it's not like Gucci pricing. You can get a coat for about $300.
Yeah, $325.
Right. Okay. Just so I know, in Vogue you can pay. There's no limit to what you can pay for the clothes in Vogue. Sometimes. What is different about your coats?
I wanted to design a coat that would protect my whole outfit. So I just was frustrated one day going to work, and half my outfit was drenched because the rain here doesn't fall straight. We have a lot of wind. So when we say sideways wind, we mean sideways wind. It really hits you in every direction. So yeah, I wanted to make something that was kind of unique in the length, but also in the look. And that's where I brought in the whole maritime look and feel to it.
Is that a Newfoundland expression, sideways rain?
Yeah, we say that a lot. Yeah.
Okay. Are you getting much buzz? Are you getting much feedback already, or orders and stuff?
Oh, well, this week has been crazy. Yeah, I'm getting such great feedback, not only from Canada, but also all over the UK. Getting lots of requests and other inquiries about the brand.
You get the coats made in China. I mean, it's just economically, well, they just don't have the industry in Newfoundland, I suppose, to make them.
And you need special equipment, and with the high volume that I'm getting now, I needed a factory that was very experienced.
Tell us, but you're a part-timer. This is not your full-time job?
No, I actually work in the maritime industry, in the ocean sector. So I help companies with research and development and bring up new concepts, looking at where the oceans are going in the next 10, 20, 50 years. So I'm always coming up with ideas. And this was kind of my own little pet project that has turned into something quite large.
And how did it originate? Did you make one of these coats for yourself, or how did the thing get going?
I kind of drew a sketch and then I hired a fashion designer to kind of put a little bit more breath to it. And then I just started contacting factories overseas that would send me prototypes. Because the material is different, you have to have special welding equipment. So I needed someone who knew how to make this type of garment. And then all my friends wanted one, my colleagues wanted one, and then I started to say, okay, there is a little bit of a gap here in this market. And then I went, in 2020, I went for it, and then I took a risk and ordered a large shipment, and now I'm on my 4th shipment, and it's going strong.
And where are they sold? Are they sold through big retail chains, or do you sell online?
Yeah, well, a lot of small boutiques that across the country, and I sell them on the shopping channel, and of course I have my own online store too.
Thank you very much indeed for joining us, Maria.
Oh, you're welcome. Thank you.
Maria Halfyard is founder of Marini.
Next week, we will get insight in how the banks are weathering current economic conditions when they report their quarterly results. There's a lot of pessimism going into these results. I noted at least 2 downgrades this week. Here's a schedule of the banks as they are set to report. November 30th is going to be a busy one. We've got 3 of the majors reporting. Our next guest doesn't want to buy any of them, well, except one. Let's bring in Nigel D'Souza of Veritas Investment Research joining us now. Nigel, thanks so much for being with me.
Thanks for having me on.
So there is a lot of caution out there, yourself included. What sort of nightmare, I guess, does the next quarter have in store for investors?
Well, I think the banks have a lot of things going against them this quarter, right? You have funding costs increasing, you have loan growth slowing. Expenses are elevated, and we have credit losses that are continuing to move up and get back to pre-pandemic levels. So there's a lot of headwinds on profitability. Some of it is priced in, a lot of it is priced into the consensus. We still think risk is skewed to the downside this quarter. Banks could incur more credit losses than expected. Margins could contract more than expected because of the funding prices we're seeing both in Canada and the other side of the border. So Not a very rosy outlook this quarter, and it's probably not until sometime next year that things start to improve.
What would get you to change your mind? What do you want to see in this quarter? It sounds like you don't think this is even going to be a stabilization quarter.
No, I think it's going to be a continuation of trends we've seen so far year to date that weighed on the banking sector. Those trends are likely to continue to persist into next year. And the question is, next year, when does a recession occur? And at what point do credit losses peak?
We might already be in one.
We might already be in one. And if we are in one, that means we're likely closer to the floor for the banking space because credit losses typically peak during a recession and bank stocks typically bottom when credit losses peak. So we think there will be a floor for the banking sector sometime next year, just far too early to call when that is.
We just got a high-profile announcement of a bankruptcy and Mastermind going bankrupt. This tends to happen when you're in a recession and you've got rates that have moved up at an unprecedented pace. How are you tracking the pace of bankruptcies and how that might feed into the Canadian banks?
Sure. So we're seeing an increase in impaired credit loss provisions year to date. A lot of it has been idiosyncratic, you could call it, commercial real estate, maybe pockets of impairment in service industries. But ultimately, if you have more exposure to cyclically sensitive sectors within your commercial loan portfolio, you're going to see that risk build up. You're also seeing some risk and stress build up in the real estate developer space due to the affordability issues for pre-sales. So stresses are mounting. It's not systemic yet. It's more idiosyncratic, but it's going to continue to increase in the next few quarters.
You like National out of all of them. Why?
Well, National Bank, first off, is concentrated in Quebec. Typically, through a recessionary cycle, Quebec has lower credit losses and a lower ceiling for credit losses than banks that are in provinces like Ontario or British Columbia. So we like that. We also like that it's less exposed to the issues that are facing U.S. banking at the moment, as well as the headwinds in Latin American banking. So we like that it's domestically focused and within Canada focused on Quebec.
There was a downgrade on National Bank in part because of concerns of a slowdown in capital markets, which has done very well for National Bank, and this exposure to a Cambodian bank, which we forget. Sometimes National Bank has got his hands in different places around the world.
That's right. The good news is that the Cambodian bank exposure they have is a very small contributor to earnings, less than 10%. And on capital markets, it can be a bit counter-cyclical. When you have a less favorable macroeconomic environment, that typically leads to elevated market volatility. National Bank has been able to maintain its revenue, particularly on the trading side, when markets are more volatile. So it's not necessarily a negative that we are heading into a period with more uncertainty.
TD is a stock that you don't recommend, but we'll be watching. I mean, it's probably in the best position when it comes to its capital levels because it didn't buy First Horizon. So within all of those challenges, isn't TD the kind of best position to execute and get around that? Or isn't that worth maybe a buy or at least a hold?
So the issue with TD is still has overhang from that regulatory review. We might get an update on the anti-money laundering issues that TD is facing this quarter. So we'll wait to see that.
Is the concern that it's going to be huge, like enough to eat into it, or it's just we don't know?
We don't know. I mean, there may be some monetary penalty that could eat at capital for TD Bank. The issue is, how does it affect or impact TD Bank's strategy in the U.S. going forward? Like, we would ultimately prefer TD focus in Canada or wealth management or capital markets because U.S. banking is a low ROE, higher risk business. I think that's been proven out over the last year, but we don't know yet if that shift is going to happen, and we're waiting to see what happens with these regulatory issues.
RBC, sort of the golden child, it has been, typically trades at a premium. Seems like it's dealing with a lot of issues on several fronts. There's now politicization about its HSBC Canada acquisition, but also signs that its City National acquisition is really struggling. Remember, they were kind of the bank to the stars.
That's right. So RBC bought City National for $5 billion. They've put in at least an additional $3 billion into City National to recapitalize the balance sheet. And the profitability has not hit the targets they outlined back when they purchased it. So it's exposed to the broader trends that are weighing on the U.S. banking sector. That's not going to go away. The good news is it's a small piece of RBC's earnings profile. And we think on the merits of whether or not HSBC Canada gives RBC a competitive advantage, the acquisition should be approved.
Yeah.
It might not be approved for political reasons, but on merits of fundamentals and competitiveness, it should be.
Let's ask a big picture question, one that I know you get a lot, concern about mortgage renewals and what happens in 24 and 25, assuming rates are where they are, maybe they come down a little bit. But how big of an issue is this for the banks specifically, or is it a question of, well, what's the wider fallout if Canadians are faced with that kind of cliff in their budgets?
Yeah, no, that's a good question. And the way to think about it is 40% of the portfolio is in mortgages, 60% isn't. When you go back to the financial crisis, loss rates on mortgages were almost close to zero. And the individuals that are renewing and seeing higher monthly payments, they likely still have equity in their home. So if they can't finance or sustain that monthly payment, they can sell their home and still probably gain positive equity. So you're not going to see, I think, loss rates on mortgages pick up, but you are going to see perhaps a decline in real estate prices as individuals list due to financial stress. That's going to lead to less real estate market activity, lower real estate prices. That will have a broader impact on Canada's economy. And then it's everything else in that loan portfolio that gets hurt. Commercial lending, credit cards, auto loans. That's what we're watching for over the next year.
All right, Nigel, that's important perspective on how to think about that. Thanks so much for joining me. That's Nigel D'Souza, analyst at Veritas.